Okay, welcome to the deep dive. Your shortcut to understanding, the complex forces shaping our world today. Wow, we're plunging into a really fascinating, almost paradoxical market situation. We've seen the S&P 500 hit a fresh record high. What is it, the 21st time this year?
Incredible, isn't it?
Yeah. And it's soared despite what many would consider some pretty weak economic data. It leaves you wondering, doesn't it, what gives? It seems Wall Street has, found a surprising sweet spot in these numbers.
Well, it's a classic market riddle, isn't it? This paradox immediately points to Federal Reserve expectations.
Okay.
See, a labor market that's slowing down, but, and this is crucial, not collapsing.
Right.
That often fuels hopes for rate cuts. It signals the economy might be cooling just enough, maybe easing inflationary pressures without triggering a recession.
Making those rate cuts more likely.
Exactly. That delicate balance, that's the sweet spot the market seems to be reacting to. And it really sets the stage for our deep dive today, connecting all these seemingly disparate headlines.
That's a crucial insight, right? So building on that paradox, our mission today is, well, it's to cut through the noise. We want to extract the most important nuggets of knowledge, the real insights from our sources. We're talking about everything from the latest job figures and what they mean for the Fed to, major tech acquisitions, surprising consumer trends.
Even a controversial health policy debate.
And soaring NFL team valuations. It's quite a mix.
It really is.
The goal, as always, is to help you understand not just what is happening, but why it matters, directly to your world. So let's unpack this, Amy. The shifting sands of the labor market and the Fed's next move. Okay, let's dive right into the heart of this economic puzzle. The labor market. It's the engine of our economy, right? And the latest numbers from the ADP private payrolls report, that's data from the payroll processor ADP, suggest that engine might be sputtering a bit.
Right, and the ADP report for August.
Yeah, just 54,000 jobs added, significantly fewer than expected. That's a dramatic slowdown from July.
Exactly, a really dramatic slowdown. It paints a somewhat concerning picture for the labor market overall.
But crucial for the Fed, you were saying.
Absolutely. ADP's chief economist, Neela Richardson, she offered some key insights into this slowdown. She pointed to a mix of things: rising consumer worries, these persistent labor shortages we keep hearing about, and even disruptions tied to artificial intelligence.
AI impacting jobs already. Interesting.
Yeah, potentially. We saw weaknesses in sectors like trade, transportation, utilities. They shed thousands of roles. Education and health services also saw declines.
Okay.
However, it wasn't all bad news. The leisure and hospitality industry, it actually saw a boom, added a robust 50,000 jobs.
Wow. So really uneven.
Very uneven. It tells us the recovery is highly segmented. Some areas are thriving, traditional sectors contracting. It makes the Fed's job of steering the economy incredibly complex.
And it wasn't just ADP sounding the alarm, was it? Other indicators came out today, too.
That's right. Jobless claims increased by several thousand from the prior week. Plus, the job openings and labor turnover survey, JOLTS.
Yeah, JOLTS.
It tracks job vacancies. It registered one of its worst levels for job openings back in July since 2020.
Okay, so definitely a cooling trend across multiple data points then.
We're seeing that signal pretty clearly, but what's particularly striking here is how the market interpreted these weak numbers.
Right, the sweet spot.
Exactly. They actually hit that sweet spot we talked about. Economists suggest an ideal range for job additions, maybe somewhere between 70,000 and 95,000, to justify a September rate cut without really sparking recession fears. The 54,000 from ADP, while lower, still kind of fits the narrative, cooling, not collapsing.
So how did the market react? Did they buy into the sweet spot narrative, or was there more caution?
Oh, the reaction was immediate and telling. Traders significantly increased their bets on a Federal Reserve rate cut at its next meeting. That's in September.
Really? How much?
CME's FedWatch tool, it tracks market probabilities for Fed rate changes. It now shows almost a 98% chance of a cut.
Wow, 90%. That's very strong.
It's a very strong signal that the market believes the Fed will act based on this kind of data.
This brings us to an interesting point, though, about the whole political context surrounding federal economic data. We've seen controversies before, right? Like President Trump firing the BLS commissioner after, what he deemed poor July data. And the current nominee for BLS Commissioner, E.J. Antoni, he's also raised concerns about government overreach and data credibility. How does this influence perception?
Well, it definitely adds another layer, doesn't it? How these statistics are perceived, how much they're trusted by the public, by the markets. When there's this cloud of political scrutiny, it can sometimes undermine confidence, regardless of the data's actual integrity. It's a constant tension.
Between independent data and political pressures.
Exactly.
And speaking of the Fed and politics, President Trump's nominee for that vacant Fed governor seat, Stephen Barron, he made headlines for his rather unusual plan.
Yeah, the leave of absence thing.
Right. He plans to take an unpaid leave from his current White House role chair of the Council of Economic Advisors, if he's confirmed.
For just a short, 4.5-month term. What concerns does this arrangement raise about the Fed's independence?
Well, it immediately raises eyebrows. The central bank's independence is just paramount to its credibility. And having someone serve at the Fed while still technically on leave from the White House, especially given President Trump's previously stated desire for sharply lower interest rates.
Right.
It creates at least a perception of potential influence. Now, Barron did publicly pledge to uphold the Fed's independence.
Okay.
And he stated he would absolutely resign if nominated for a longer term. But the arrangement itself, it's certainly something to watch in terms of the institution's perceived impartiality.
Okay.
2, consumer confidence, retail, and travel. A mixed outlook.
Okay, so the Fed's watching the labor market closely. What about the consumer? Their spending habits, that's another critical piece of this economic puzzle, especially, as we head into the holiday season.
We're looking at holiday inventory levels now as our tea leaves, trying to understand retailer health and consumer spending strength. And what's striking is the difference in strategies between the big guys and the small retailers. The Logistics Management Index highlighted this.
Yeah, the contrast is really fascinating. You've got the large retailers like Walmart. They're rationalizing their product mixes, focusing on the sure sellers, ordering earlier to get quantity discounts. They're even absorbing some of those tariff costs to keep prices stable.
Okay, so they have the scale to do that.
Exactly. But the smaller firms, they're struggling to compete. They're facing higher inventory costs, especially with goods arriving after those April 2nd tariffs hit. We saw Dollar Tree's stock fall, specifically because of higher cost, lower margin products hitting their shelves. It really shows that scale is the ultimate shield right now.
Larger players can absorb costs, dictate terms, leaving smaller firms just struggling.
Pretty much, yeah.
And the tariff impact sounds like it's really starting to bite. We heard Petco's management predicting meaningful effects in Q3.
And much more meaningful in Q4.
Wow.
Absolutely. And this raises a big question. Who's feeling the pinch most? Our sources indicate lower-income consumers are definitely pulling back. No surprise there, perhaps. But even middle to upper middle-income shoppers are reportedly trading down.
Yeah.
Meaning choosing cheaper options, maybe store brands instead of national brands.
Got it.
So retailers are zeroing in on products that sell quickly. They're slimming down on SKUs, that's stock-keeping units. Basically, the variety they offer, just trying to manage all this uncertainty.
Makes sense.
And we're also seeing a broader signal of softer demand. There's a noticeable lack of that traditional late August ocean cargo surge from China. Booking volumes to the U.S. are down significantly, like 20% in the past 6 weeks.
That suggests softer demand ahead.
It certainly points that way.
Yet, amidst these challenges, we found some surprising bright spots, like the auto industry. Ford's big gas-powered Expedition SUV, explosive sales growth last month. Its best in over 2 decades. Even with this broader rush to get EVs, seems America still loves its big SUVs.
Well, it really highlights Ford's unique strategy, doesn't it? While their EV sales are up, probably helped by those federal tax credits ending soon, the company actually canceled plans for a 3-row electric SUV about a year ago.
Oh, interesting.
Instead, they're prioritizing hybrids. CEO Jim Farley put it perfectly. He said Ford is out of sync in a good way compared to competitors who are fully loaded with EVs.
Out of sync in a good way. I like that.
It shows there's still real consumer willingness to spend on these large traditional vehicles. Popular Expedition models start around $74,000. That's not cheap.
No, definitely not. It's a fascinating counter-trend. And another interesting strategic shift, Gap Inc. They announced they're expanding into beauty products.
Beauty, okay.
Yeah, starting with a test in some Old Navy stores this fall, planning to scale it next year. Seems like a smart move, maybe. The beauty and personal care market is huge, projected over $100 billion this year. Seems resilient.
It does seem resilient. Now, if we connect this back to the bigger picture of consumer behavior, the travel sector, that offers a somewhat more concerning picture.
Okay, travel. What are we seeing there?
Las Vegas visitation. Declined for 7 straight months. July alone was down 12% year over year. That's significant.
Ouch.
MGM Resorts CEO Bill Hornbuckle insists, Las Vegas is not done or dead, but he does acknowledge they need to rethink the value creation narrative.
And Hornbuckle sees this Vegas slump as, what, a warning sign? A leading indicator for wider U.S. travel?
That's how I framed it, yeah.
Yeah.
A leading indicator. And he's pointing to several troubling obstacles.
Like what?
For example, Canadian visitation to the U.S. plummeted 40%. He links it to President Trump's comments and a weaker Canadian dollar.
40%, wow.
Yeah. Plus, massive U.S. visa price hikes jumped from $100 to $350. That's a huge barrier for international travelers.
Yes.
And it's not an isolated thing. Government funding for marketing U.S. travel slashed by 80%. Down to just $20 million. It's contributed to this dramatic shift. We went from a $50 billion international travel surplus in 2016 to a $50 billion deficit today.
That's a massive swing.
It really is. Now, Marriott CEO Tony Capuano, he notes spending restraint among budget travelers, but says demand for luxury travel is still sturdy.
So a split there, too.
Seems like it. And Wyndham CEO Jeff Bellotti, he's still optimistic about hotel construction, thinks it's being driven by infrastructure spending. So some mixed signals within travel itself.
And on the airline front, we're seeing struggles, too. Spirit Airlines. Second bankruptcy filing in less than a year.
Yeah, tough times for Spirit. They're cutting flights in a dozen cities.
And rivals like United and Frontier are, what, circling?
That's the term used, yeah. They're adding routes in Spirit's markets. United's even apparently preparing for the possibility that Spirit might, suddenly go out of business.
Well, not good for Spirit.
No. And what's interesting here is a recent policy reversal. The Trump administration dropped a Biden-era plan.
The one about cash compensation for flight disruptions.
Exactly. It would have required airlines to pay cash. Airlines sharply criticized it, argued it would just raise ticket prices.
So that's off the table now.
Looks like it. Currently, major U.S. carriers, they mostly just commit to meals and hotels for their disruptions, which, contrasts with places like Canada, Brazil, the EU, the UK. They all have more comprehensive compensation rules.
Right, different standards. 3, the AI and tech frontier. Big deals, big bets, and market volatility. Okay, so from the broader economy, let's zoom in on a sector that sometimes feels like it's operating on a completely different plane. AI and tech deals.
Yeah, warp speed over there.
Seriously, valuations aren't just soaring, they're kind of redefining what's possible. We just heard Atlassian agreed to acquire the browser company.
Makers of Arc and Dia browsers, yeah.
For $610 million. In cash. That's a lot for a browser company, isn't it? What's the vision there?
Well, Atlassian CEO Mike Cannon-Brookes has a clear vision. He believes current browsers just aren't built for work. So Atlassian wants to enhance the browser company's tech, leverage its own enterprise expertise, make browsing more productive for work tasks.
Okay, makes sense for Atlassian.
And what's even more interesting, other big players were apparently looking too. OpenAI, Perplexity. Perplexity reportedly offered Google an astonishing $34.5 billion for Chrome.
Wait, $34.5 billion for Chrome?
That's the report. It just speaks volumes about the perceived value of AI-powered browsing and controlling that interface.
No kidding. And the AI boom keeps creating new titans. Brett Taylor's Sierra, latest AI startup to hit the $10 billion club.
That's right. Just closed a $350 million funding round at that valuation.
What exactly does Sierra do?
They build and implement AI agents primarily for customer service. Apparently, these agents are already used by hundreds of millions of people for various tasks, things like refinancing homes or even just ordering lunch.
Wow. So practical applications already at scale.
Seems so. And Sierra now joins those other AI powerhouses like OpenAI, Anthropic, and that super high valuation tier. Anthropic itself recently closed a $13 billion funding round at a mind-boggling $183 billion valuation.
$183 billion, the speed of growth, the capital flowing in. It's just unprecedented.
Truly is.
And powering a lot of this AI boom are companies like Broadcom. Their shares have almost doubled in the past year.
Yeah.
A key beneficiary.
Oh, absolutely critical. Broadcom develops custom chips, sometimes kind of XPUs or accelerators, specifically optimized for AI processing. They make these for Google and other huge cloud companies, and they also create the essential networking gear you need to connect, thousands of these AI chips together in data centers.
So the plumbing and the engines of AI.
Pretty much. Analysts project huge revenue growth for Broadcom's custom silicon, potentially over $40 billion by 2027.
$40 billion. Wow.
Yeah. We saw their Q2 AI revenue jump 46% to $4.4 billion, expected to hit $5.1 billion in Q3. Just rapid ascent.
But it's not all smooth sailing in tech, is it? We saw Figma's stock plummet today, almost 20%.
Yeah, a rough day for Figma. Fell to its lowest since its July IPO. It's lost more than half its value now.
Despite reporting better than expected Q2 revenue.
Exactly. Which tells you something about the volatility. Even good revenue doesn't guarantee stability when the market is so intensely focused on future growth expectations, especially after a high-profile IPO.
It's a tough market for some.
Definitely. Meanwhile, though, look at Amazon. Shares jumped over 4% today.
Why Amazon?
Driven by increased enthusiasm, as the report put it, surrounding its deep relationship with Anthropic.
The AI connection again.
Right. Anthropic's Claude models, they're primarily trained on Amazon Web Services, AWS, using Amazon's own chips. So this shows how crucial these strategic partnerships are. They really drive market reactions and investor confidence in this whole AI ecosystem. 5-5. Policy, public impact, and unexpected valuations.
Okay, let's pivot now to policy that directly impacts, well, a lot of Americans. Social Security. Senator Ruben Gallego, Democrat from Arizona, introduced a new bill, the You Earn It, You Keep It Act. Aims to permanently eliminate federal taxes on Social Security benefits.
Yeah, that's a big proposal. How does it compare to current policy?
Well, currently, President Trump's Big Beautiful Bill, as it's called, only provides a temporary senior deduction, up to $6,000 for those 65 and older.
Okay, temporary.
And only for tax years 2025 through 2028. Plus, it phases out for higher incomes.
Got it. So Gallego's bill is permanent and universal.
It removes federal taxes entirely, yes.
Yeah.
But it also proposes something else, expanding the Social Security payroll tax.
Oh, how so?
Making it apply to annual earnings over $250,000. Currently, the cap is much lower, around $176,000 for 2025.
Okay, so raise the cap significantly.
Right. And this proposal, it's supported by the Senior Citizens League. It's projected to extend the Social Security Trust Fund's solvency, basically their ability to pay full benefits for another 24 years.
Yeah.
Out to 2058.
So shore up the finances by taxing higher earners more, while eliminating the tax on benefits for everyone.
That seems to be the idea. It tackles both benefit taxation and long-term funding.
Interesting trade-off. Definitely something that will spark debate.
No doubt. Now, let's address a highly controversial area, the politicization of public health. Health and Human Services Secretary Robert F. Kennedy, Jr. testified recently before the Senate Finance Committee. Reports say he doubled down on false claims about vaccines and clashed with Democrats over COVID shot access. What was the core of this debate? We need to be impartial here, just reporting what the sources say.
Right. Okay, so according to the reports, Kennedy expressed support for a statement made by a newly appointed CDC vaccine panel member, a statement claiming mRNA vaccines pose a dangerous risk.
Despite studies affirming safety and effectiveness.
Correct. The sources note numerous studies affirming safety. Kennedy's reported policy changes include canceling funding for mRNA shot development, significantly changing the composition of the CDC vaccine panel, and dropping COVID shot recommendations for certain groups.
And how did critics react?
Senator Elizabeth Warren argued this is effectively taking away vaccines. And former CDC Director Susan Manares accused Kennedy of a deliberate effort to weaken America's public health system.
So, clear clash.
Yes, a fundamental disagreement reported between the Secretary's stance and actions and the views of public health officials and critics in Congress, centering on scientific consensus versus alternative views and the government's role in public health policy.
Okay. Important to understand the different perspectives presented in the sources. Finally, let's end with an intriguing shift. The world of sports business. Specifically, the unstoppable rise of NFL team valuations, according to CNBC's latest report.
Yeah, it sometimes feels like sports business operates on another planet, doesn't it?
It really does. The NFL is the most valuable and profitable sports league in the world. No shock there, maybe.
Right, but the numbers are still staggering. The average franchise is now worth $7.65 billion.
Average. $7.65 billion.
That's the average, an 18% jump from just last year.
Incredible growth.
And the Dallas Cowboys, they retained their top spot, valued at $12.5 billion. They posted the highest revenue, $1.27 billion, and highest sponsorship revenue, too.
$12.5 billion.
The Los Angeles Rams are up there, too, around $10.7 billion.
What's underpinning this, besides just popularity?
Well, popularity translates to eyeballs. NFL games accounted for, what, 72 of the 100 most watched U.S. telecasts in 2024?
72 out of 100.
Yeah. And those media rights deals, they generate $12.4 billion annually. Just massive, stable revenue streams.
Okay, media rights are huge.
And there's another factor, allowing private equity firms to buy minority stakes. That's had a significant impact.
How so?
It's basically set a floor on valuations,
Right.
and it's erased concerns over liquidity for existing owners wanting to cash out some value without selling the whole team.
Makes selling smaller pieces easier.
Exactly. We've seen recent minority stake sales like the Chicago Bears. Their pending deal for just a 2.3% stake would value the whole team at a record $8.9 billion.
Wow. Based on just a tiny slice.
And the NFL itself is making strategic moves. They got a 10% equity stake in ESPN as part of a deal. That stake alone is estimated to be worth maybe $2-3 billion.
The league owns part of ESPN now.
Essentially, yes. And they got a small ownership stake in Paramount Skydance, too. So they're not just collecting media fees. They're intertwining themselves financially with major media players, securing future value. Very savvy.
Very savvy indeed. Outro. Wow, what a journey we've taken today. Seriously, we've covered the delicate balance of the labor market, Fed policy,
Evolving retail strategies, travel ups and downs,
the relentless innovation and crazy valuations in AI,
policy debates on Social Security and public health.
all the way to those soaring NFL valuations. It's truly fascinating just how interconnected these seemingly disparate events really are.
Absolutely. Today's deep dive, I think it really illustrated that constant interplay, between the big macro trends, individual business decisions, policy shifts, and how it all directly impacts our daily lives.
Yeah, from companies like Broadcom literally powering the AI revolution.
Yeah, to those really controversial policy shifts happening within HHS. Every piece is connected, sometimes in ways we might not initially see.
So the big question then, what does this all mean for you listening right now? As we've seen, every piece of news, whether it's a surprising surge in gas-guzzling SUV sales or a major tech acquisition or a debate over vaccine policy, ripples through the economy. So what aspects of today's deep dive do you think will have the most significant impact on your wallet, maybe your career, or just your daily choices in the coming months? And how might you prepare?
Yeah, it's about thinking critically, right? Understanding these interconnected forces, it allows you to question assumptions, consider different viewpoints, hopefully make more informed decisions in this world that's just brimming with information. Keep observing how these threads weave together. The real value, I think, is in connecting the dots for yourself.